While the world sleeps this Sunday, something just cracked beneath the surface of the financial system. The dollar is slipping, the metals are moving, and the one sector nobody is watching is quietly loading a spring that has not snapped like this in decades. On the charts, it looks calm, almost boring, but beneath the numbers, the math is screaming that a massive repricing may already be underway. Institutions are still frozen. The crowd still thinks this is temporary. And history shows that the biggest wealth shifts never ring a bell before they begin. So the real question is not if something is changing, but who positions first before the door gets crowded. Welcome to Market Metal, a calm place where we slow the noise down and look at the numbers that most people scroll past. If you've been watching markets for years, you already know patience beats panic. So consider subscribing and joining this circle of steady thinkers. And before we go further, tell us in the comments, where in the world are you watching from today? Which city is seeing these markets with you? The signal the market is ignoring. On a quiet Sunday, when most trading floors were dark and the public was focused on routine news, a small group of market observers noticed a change that did not fit the usual pattern. They were not reacting to headlines or social media noise. They were watching the slow movement of a few key numbers that often speak before the rest of the system does. In that moment, the signal was not loud, but it was clear enough for those trained to see it. The currency index that measures the strength of the US dollar had slipped below a level that many institutions once treated as a floor. It did not look dramatic on a short chart. Yet for professionals who study long cycles, this type of move is rarely just a temporary fluctuation. It often reflects deeper pressure building inside the monetary system. These observers understood that currency weakness does not always show up first in stock markets. Equities can remain calm for weeks or even months, while structural stress grows beneath them. Capital markets are complex, and different asset classes respond at different speeds. Hard assets, especially monetary metals, have historically reacted earlier to shifts in confidence. They do not depend on future earnings promises or policy guidance. They simply reflect what participants are willing to exchange for something tangible. When that exchange rate begins to move quickly, experienced capital allocators take notice. At the same time, the broader investment community appeared uncertain. Many portfolio managers were still anchored to models built during a long period of low inflation and stable interest rates. For decades, those models rewarded patience in traditional assets. Bonds provided income, equities provided growth. Commodities were treated as short-term trades rather than strategic holdings. Because of that history, the first reaction to any sharp movement in metals was often skepticism. Analysts would assume that the move was temporary, caused by speculation or short-term positioning. This response was understandable, but it also created a blind spot. The blind spot became more visible when comparing the price of silver with the behavior of the companies that produce it. In theory, if the underlying product becomes more valuable, the businesses that extract and sell that product should also see stronger valuations. Yet the market was not fully reflecting this relationship. Many mining equities were still priced as if the metal were trading much lower. This gap did not mean the market was irrational. It meant that investors were relying on expectations formed during earlier cycles. They were waiting for the price to return to what they considered normal. From a strategic perspective, this waiting period is often called the disbelief phase. During this stage, the data begins to change. But most participants hesitate to adjust their assumptions. They prefer confirmation. They prefer stability. They prefer to avoid the risk of acting too early. Institutions in particular are designed to move slowly because they manage other people's money. Committees require evidence, reports, and multiple layers of approval. By the time consensus forms, the initial opportunity has usually narrowed. A small group of analysts approach the situation differently. Instead of focusing on short-term price charts, they examined the structure of the system. They asked simple questions. What happens to hard assets when currency purchasing power weakens over time? How do resource businesses respond when their product price rises faster than their operating costs? And how long does it take for large pools of capital to recognize and react to those changes? These questions were not emotional, they were operational. Their first observation was that metals often act as early indicators rather than late ones. In previous monetary stress periods, gold and silver tended to move before broader markets fully acknowledged the shift. This pattern does not guarantee the same outcome every time, but it does provide context. When a non-yielding asset begins to attract attention, despite offering no income, it usually reflects a search for stability rather than speculation alone. Investors are signaling concern about the reliability of other instruments. The second observation involved market psychology. After major commodity downturns in the past, many participants developed a habit of expecting sharp reversals. They remembered previous peaks followed by long declines. Those memories influenced current decisions. Even when new conditions were present, the emotional weight of past losses made them cautious. Behavioral finance research has repeatedly shown that losses are felt more strongly than gains. As a result, Investors often demand stronger proof before re-entering a sector that once disappointed them. Meanwhile, trading systems and quantitative models reinforce this caution. Many algorithms are built on mean reversion assumptions. They are designed to expect that prices will return to historical averages. When a price moves far from those averages, the models interpret it as an anomaly rather than a new baseline. This approach works well in stable environments, but can lag during structural transitions. If the underlying conditions have changed, the average itself may no longer be relevant. This combination of human memory and automated rules created a temporary disconnect. The visible price of the metal suggested one reality, while the valuation of related equities suggested another. Such gaps do not persist indefinitely. Capital markets tend to reconcile differences once enough data accumulates. The key question is not whether the gap will close, but how and when it will adjust. Sometimes the underlying asset retreats. Other times, the associated sector reprices upward. Determining which path is more likely requires examining fundamentals rather than headlines. From a macro perspective, currency stability plays a central role. When confidence in a currency weakens, even slightly, participants begin to diversify into alternatives that are not tied to a single issuer's balance sheet. This does not happen overnight. It begins quietly, often through small allocation shifts. Family offices may move first because they have flexibility. Smaller funds may follow once performance data supports the decision. Larger institutions usually act last because their size limits agility. Yet when they do move, their scale amplifies the effect. Another factor influencing the current environment was the shift in correlation between traditional assets. During earlier decades, bonds often rose when equities fell, providing balance to portfolios. In more recent periods of higher inflation, that relationship weakened. Both asset classes sometimes declined together. For portfolio managers responsible for long-term liabilities, this created a challenge. The tools that once reduced volatility were no longer as reliable. Searching for assets with different behavior became a strategic necessity rather than a tactical choice. Within that search, commodities, and especially monetary metals, began to regain attention, not because they offered yield, but because they represented tangible value. They are not promises of future payment. They are physical resources with industrial and historical monetary roles. When investors reconsider these characteristics after a long period of neglect, the adjustment can be gradual at first. Price signals appear before allocation shifts become visible in large datasets. The observers who tracked these developments did not claim certainty about immediate outcomes. Instead, they focused on probabilities. If currency pressure persisted, and if traditional portfolio hedges remained less effective, then demand for alternative stores of value would likely increase. If that demand increased, while supply growth remained slow, prices would continue to adjust. And if prices continued to adjust, sectors previously ignored could attract renewed analysis. Their conclusion at this stage was not a prediction of a single event. It was a recognition that multiple indicators were aligning in an unusual way. Currency weakness, metal price strength, hesitant equity response, and shifting portfolio correlations rarely appear together without consequence. Each factor alone might be dismissed. Combined, they suggested that the market was entering a period where old assumptions would be tested. For the broader business community and emerging entrepreneurs, the lesson was practical. Markets do not always announce structural changes with dramatic headlines. Often, the earliest warnings are subtle and require patience to interpret. Those who rely only on consensus may react after valuations have already adjusted. Those who study underlying mechanics can at least recognize when the environment is no longer operating under familiar rules. At this point in the analysis, the signal remained quiet but persistent. The numbers did not demand panic, they demanded attention. The system had not failed, but it was clearly under strain. And in capital markets, strain is often the first stage before repricing. The critical task for decision makers was to observe without emotion, measure without bias, and prepare for the possibility that the conditions shaping the last decade might not define the next one. The mathematics of mining profit expansion. While the first stage of the analysis focused on signals coming from the currency and the metal itself, the second stage moved deeper into the machinery that actually produces the resource. A quiet but decisive question guided this phase. If the price of silver changes significantly, how does that change flow through the financial structure of the companies that mine it? Many investors watch the metal price every day, yet far fewer examine the operational mathematics behind the businesses that extract it. This is where the disparity begins to reveal itself. Inside the boardrooms of primary silver producers, executives do not think in terms of daily chart movements. They think in terms of cost per ounce, production volumes, and cash flow stability. Their central metric is often the all-in sustaining cost, commonly called AISC. This number represents the full expense required to pull 1 ounce of silver from the ground, process it, refine it, maintain equipment, and keep the operation running over time. It includes fuel, labor, maintenance, permitting, and ongoing capital needs. For many established producers, This cost has historically hovered within a relatively stable range, moving slowly compared with the volatility of the metal price. 2 years earlier, when silver traded near much lower levels, a typical operation might have generated modest margins. The revenue from selling an ounce exceeded the cost of producing it, but not by a dramatic amount. It was a steady industrial business, profitable yet dependent on disciplined management and efficient processes. In such an environment, investors valued these companies conservatively. Earnings were predictable, but growth expectations were limited. The current environment, however, introduced a different equation. Even after accounting for inflation in diesel, labor, and materials, production costs did not rise at the same pace as the selling price of the metal. Costs tend to move gradually because contracts, infrastructure, and long-term supply agreements create inertia. Revenue, by contrast, can change quickly when the commodity price shifts. This mismatch between slow-moving costs and fast-moving revenue is the foundation of what resource analysts call operational gearing. Operational gearing is not a complex theory. It is a simple mathematical reality. When a company's fixed and semi-fixed costs are already covered, each additional increase in the selling price flows disproportionately into profit. A modest rise in costs paired with a large rise in revenue does not produce a linear improvement. It produces an exponential one. The business that once earned a small margin per ounce can suddenly generate several times that amount without expanding production at all. From an analytical perspective, this is where the market's hesitation becomes significant. Equity valuations often lag during the early stages of such transitions because investors assume the price surge will reverse. They hesitate to adjust their earnings models. They apply conservative metal price assumptions to future projections, preferring to wait for confirmation before repricing the sector. This behavior is rational in a typical cycle, but it becomes problematic if the underlying price shift is structural rather than temporary. Inside the financial statements of these companies, the change is already visible. Revenue lines expand faster than operating expenses. Cash flow strengthens. Debt ratios improve as excess earnings are used to reduce liabilities. Balance sheets that once appeared average begin to look unusually robust. For long-term analysts who study quarterly filings, these improvements are difficult to ignore. Yet the broader market may still focus on past performance rather than forward capacity. Another layer of complexity comes from the way institutional models evaluate resource firms. Many quantitative strategies rely on trailing data, historical earnings, prior margins, and established valuation ranges. When a sudden expansion in profitability occurs, these models require time to update. They must observe several reporting periods before reallocating capital. During that delay, the shares can remain priced for a lower earnings environment even as real profitability accelerates. This delay creates a temporary vacuum between operational reality and market perception. In that space, early analysts begin to recalculate future cash flows using current price assumptions rather than historical averages. Their projections often show a dramatic improvement in free cash generation. With stronger cash flow, companies gain strategic options. They can retire debt, which reduces financial risk. They can initiate share buyback programs, shrinking the float and increasing per-share value. They can introduce or expand dividend policies, attracting income-focused investors who previously ignored the sector. Each of these actions changes how the market classifies the business. A company once seen as a cyclical commodity producer begins to resemble a high-yield cash generator. That shift in perception is critical because different pools of capital are allowed to invest based on specific mandates. Income funds, value strategies, and certain pension allocations may only enter once dividends or consistent earnings thresholds are met. When those thresholds appear suddenly, new demand for the shares emerges from groups that were previously absent. At the same time, the size of the sector introduces another constraint. The global universe of primary silver producers is relatively small compared with major technology or consumer industries. Their combined market capitalization represents only a fraction of larger equity segments. This means that even modest institutional interest can have an outsized impact on pricing. A single mid-sized fund adjusting its allocation can move the share price more than expected because the available float is limited. The situation becomes more complex when multiple funds attempt similar adjustments simultaneously. Portfolio managers often track the same indicators and respond to the same earnings surprises. If several institutions conclude that projected margins have structurally improved, they may attempt to increase exposure at the same time. In a thin sector, this synchronized behavior can produce sharp upward repricing rather than gradual appreciation. From a behavioral standpoint, this phase is often characterized by disbelief turning into reluctant acceptance. Analysts who initially dismiss the metal price as temporary begin revising their models. Research notes shift language from cautious to neutral, then from neutral to constructive. Each revision signals to additional investors that the risk profile has changed. Momentum is not created by excitement alone. It is created by successive adjustments in expectations. There is also a strategic dimension tied to capital discipline. Resource companies that experienced difficult cycles in the past often learn to control expansion spending. Instead of immediately increasing production when prices rise, many choose to strengthen balance sheets first. This restraint prevents oversupply and extends the period of elevated margins. For investors evaluating long-term value, disciplined management becomes a multiplier on already improving economics. As these elements converge, higher realized prices, contained cost growth, stronger cash flow, and limited sector size, the probability of a valuation reset increases. Markets rarely ignore sustained earnings expansion. Eventually, price-to-earnings ratios adjust to reflect new realities. When they do, the adjustment can appear sudden even though the underlying change developed gradually over several quarters. For entrepreneurs and business leaders observing from outside the sector, the broader lesson is about leverage within operating models. Businesses with high fixed infrastructure and scalable output can experience disproportionate gains when pricing power improves. The principle applies beyond mining. It appears in logistics, manufacturing, and technology platforms. Understanding where costs are fixed and where revenue can expand is essential to identifying hidden optionality within any enterprise. At this stage of the narrative, the suspense does not come from uncertainty about whether margins have expanded. The numbers already demonstrate that they have. The suspense lies in how long the market will take to fully acknowledge it. Capital markets are efficient over long horizons, but imperfect in the short term. When reality advances faster than perception, a repricing phase becomes increasingly likely. The analytical conclusion of this second stage is straightforward. The profit mechanics inside the mining sector have shifted more dramatically than most valuation models currently reflect. Costs moved incrementally, while revenues accelerated. This created an earnings profile that differs sharply from historical norms. The remaining question is not whether the mathematics is valid. It is whether the broader market will recognize and act on it before the window for early positioning narrows. Structural supply constraints and inelastic industrial demand. By the time analysts reached the third stage of the briefing, the focus shifted away from prices and profits and moved toward a more fundamental question. Even if demand for silver continues to grow, can the world actually produce enough of it in time? This was not a question about market sentiment. It was a question about geology, engineering, and the physical limits that govern resource extraction. In many industries, higher prices invite a rapid increase in supply. In the case of silver, the response is far slower, and that delay changes the entire strategic landscape. Economists often describe supply using the idea of elasticity. In simple terms, elastic supply means producers can quickly increase output when prices rise. Agriculture is the common example. If the price of a crop becomes more attractive, farmers can adjust planting decisions for the next season. Within months, additional supply reaches the market and pressures prices back toward balance. This mechanism has worked for centuries because soil, seeds, and growing cycles are relatively flexible. Mining does not operate under the same rules. A mining company cannot simply decide to produce more metal next quarter because the price is favorable. The resource must already exist in the ground, and it must be accessible at an economic grade. Discovering a new deposit requires exploration, geological surveys, and often years of testing. Even when a viable deposit is found, the path from discovery to production is long and expensive. Permitting alone can take several years, followed by environmental reviews, infrastructure development, and construction of processing facilities. Industry data has shown that the average timeline from initial discovery to first commercial output can stretch close to a decade or more. This long lead time creates a structural delay between price signals and supply response. When prices rise today, the additional production that could relieve pressure may not appear until many years later. During that interval, existing supply becomes the only meaningful source available to meet demand. In a stable environment, this delay is manageable. In a period of rapidly increasing demand, it becomes a bottleneck. Another constraint is geological quality. Over the past half-century, many of the highest-grade deposits were already developed. What remains in many regions are lower-grade ores that require moving more rock to extract the same amount of metal. This increases energy use, processing time, and overall cost. Even with modern technology, physics sets limits on how efficiently material can be separated. As grades decline, expanding output becomes progressively harder, not easier. A further complication lies in how silver is actually produced. A significant portion of global supply does not come from mines dedicated primarily to silver. Instead, it is recovered as a byproduct from operations focused on other metals such as copper, lead, and zinc. These mines make production decisions based on the economics of their primary metal, not on the price of silver. If demand for base metals weakens due to a slowdown in construction or manufacturing, those operations may reduce output. When that happens, the secondary flow of silver also declines, regardless of how strong the silver price appears. This dynamic introduces a paradox. In a scenario where economic growth slows, base metal demand may fall, reducing byproduct silver supply. At the same time, uncertainty in financial markets can increase interest in monetary metals as a defensive allocation. The result is a tightening of supply, just as certain forms of demand rise. Because the silver produced by those base metal mines cannot be quickly replaced, the deficit can persist longer than expected. On the demand side, silver occupies a unique position among industrial materials. It is not only a store of value, it is also an essential input for modern technology. Its physical properties, especially electrical conductivity and thermal efficiency, make it difficult to substitute in high-performance applications. Solar panels rely on silver paste for efficient energy conversion. Advanced electronics require it for reliable connections. Emerging technologies, including certain forms of energy storage and high-speed computing, also depend on its characteristics. In many of these applications, the cost of silver represents only a small fraction of the final product's total value. For a large manufacturer, the expense of securing reliable supply is often less significant than the cost of halting production. This means that even if the price rises, demand does not decline proportionally. Economists describe this behavior as inelastic demand. The buyer may complain about higher costs, but they continue purchasing because the material is essential. When inelastic demand meets constrained supply, the market can enter a sustained deficit. Instead of prices quickly returning to equilibrium, they adjust upward until enough holders of existing inventory are willing to sell. In practical terms, this often shows up as widening premiums for physical delivery, longer wait times from refiners, and increased direct sourcing agreements between manufacturers and producers. These signals may appear quietly before they are reflected in widely followed price benchmarks. Another important shift occurs when large industrial users reconsider their procurement strategy. Rather than relying solely on futures contracts or spot purchases, they may seek long-term supply agreements or even invest directly in production assets. This vertical integration approach has been observed in other resource sectors when availability becomes uncertain. Owning or securing upstream supply reduces exposure to volatile markets and ensures continuity of operations. From a strategic viewpoint, this behavior changes the competitive environment. Mining companies that control proven reserves gain leverage because they represent future production that cannot be easily replicated. Their value is no longer measured only by current output, but also by the quantity and quality of material still in the ground. In periods of perceived scarcity, these reserves become a form of strategic collateral. The broader market does not always recognize this shift immediately. Traditional valuation models often emphasize present cash flow rather than long-term resource ownership. However, when supply constraints persist, analysts begin to incorporate reserve life and replacement difficulty into their assessments. This can lead to a re-rating of companies that possess large, high-quality deposits, especially if new discoveries remain limited. At the same time, the physical market operates under different incentives than the paper market. Traders may attempt to manage price exposure through derivatives, but industrial buyers prioritize delivery certainty. If confidence in future availability declines, the willingness to pay a premium for guaranteed supply increases. This behavior gradually transfers pricing influence from leveraged trading activity toward actual inventory holders. The suspense within this phase of the analysis comes from timing rather than direction. Geological limits, long development cycles, and byproduct dependency are not temporary factors. They are structural features of the industry. Once demand begins to press against those limits, the adjustment process can extend over multiple years. Markets may oscillate in the short term, but the underlying constraint remains. For business leaders and entrepreneurs studying the sector, the lesson is about recognizing when a market's constraints are physical rather than financial. Financial bottlenecks can be resolved with capital. Physical bottlenecks require time, expertise, and often new discoveries. When time is the limiting factor, price becomes the mechanism that balances competing needs. At this stage of the narrative, the evidence suggests that silver does not behave like a typical commodity with rapid supply response. Its production pipeline is slow, its grades are declining, and much of its output depends on unrelated mining activity. Meanwhile, its industrial role continues to expand. These conditions create an environment where shortages, once formed, are difficult to resolve quickly. The strategic implication is not that prices must move in a straight line, but that the foundation supporting them is different from past cycles driven purely by speculation. When supply is rigid and demand remains necessary, the market's adjustment path becomes narrower. Decision makers observing these dynamics are less concerned with daily volatility and more focused on the structural gap that cannot be closed overnight. Institutional capital rotation and the liquidity constraint. By the time the analysis reached its final stage, the focus shifted from geology and corporate margins to the largest force in modern markets, capital allocation. The earlier sections established that signals were emerging from currency behavior. that mining profits were expanding faster than most models reflected, and that physical supply could not respond quickly to rising demand. The final question was therefore strategic rather than technical. What happens when large pools of global capital begin to notice the same data? For decades, institutional investors operated under a framework that appeared reliable. The standard portfolio structure, often described as the 60-40 model, allocated the majority of assets to equities for growth, and a significant portion to government bonds for stability. This balance worked because bonds historically moved in the opposite direction of stocks during periods of stress. When equities declined, falling interest rates often pushed bond prices higher, cushioning overall portfolio losses. It was a system built on predictable correlations. In recent inflationary environments, however, that relationship began to weaken. There were periods when both stocks and bonds declined together, eroding the protective function that fixed income once provided. For pension funds, insurance companies, and endowments, this presented a structural challenge. Their primary objective is not short-term performance, but long-term preservation of purchasing power. When their traditional hedges no longer behaved as expected, they were forced to reassess where true diversification could be found. Within internal strategy meetings, the conversation gradually expanded to include assets that had been ignored for years. Commodities, and specifically monetary metals, re-entered the discussion, not because they offered yield, but because they were not dependent on any single government's promise to pay. In an environment where debt levels were high and real returns on bonds were under pressure, the absence of counterparty risk began to look less like a disadvantage and more like a defensive feature. The scale of institutional capital is difficult to visualize. Global pension and sovereign wealth funds collectively manage tens of trillions of dollars. Even small percentage shifts in allocation represent enormous absolute flows. If a large fund decides to increase its exposure to hard assets by a fraction of a percent, the amount of money entering that sector can exceed the annual revenue of entire industries. This is where the imbalance becomes critical. The precious metals and mining sector is comparatively small. Its total market capitalization is only a narrow slice of global equity markets. Unlike major technology or consumer sectors, it does not have deep liquidity across hundreds of large companies. Instead, it consists of a limited number of producers, royalty firms, and exploration businesses, many of which trade with modest daily volume. This creates what analysts sometimes describe as a liquidity keyhole, a situation where a very large amount of capital attempts to move through a very small opening. When institutional demand approaches such a constrained market, price discovery can accelerate quickly. Portfolio managers cannot deploy billions of dollars without moving the market against themselves. Even carefully staged buying programs can push prices higher simply because there are not enough willing sellers at previous levels. In thin sectors, incremental demand has a disproportionate effect. Another force amplifies this process. Modern markets are heavily influenced by passive investment vehicles and index tracking funds. As the price of a sector rises, its weight within major indices increases. Funds that replicate those indices must purchase additional shares to maintain alignment. This creates a feedback loop. Rising prices trigger more mandatory buying, which in turn pushes prices further. The mechanism is mechanical rather than emotional, yet its impact can be significant when liquidity is limited. At the same time, early movers among private capital, family offices, and specialized funds often act before large institutions reach consensus. These groups have fewer bureaucratic layers and can adjust allocations quickly. Their purchases may appear modest compared with global pension flows, but they serve as the first wave that tightens available supply in the public market. By the time larger entities attempt to enter, a portion of the float is already held by long-term investors with little incentive to sell. This sequence, nimble capital first, institutional capital later, has been observed in previous resource cycles. What makes the current environment distinct is the combination of constrained physical supply, expanding producer margins, and shifting portfolio correlations. Each factor alone might produce gradual change. Together, they increase the probability of abrupt repricing. From a strategic standpoint, institutional decision makers must consider not only expected returns, but also relative positioning. No fund wants to be significantly underexposed to the only asset class showing resilience during a period of broader market weakness. Once performance differentials become visible, competitive pressure encourages alignment. Managers begin to adjust allocations not just for diversification, but to avoid lagging peers. This behavioral dynamic can accelerate capital rotation even without a formal industry-wide directive. There's also a geopolitical dimension influencing long-term asset choices. Some regions have increased their focus on securing tangible resources, energy, metals, and agricultural inputs, as part of broader economic resilience strategies. When sovereign entities prioritize physical ownership over financial claims, it reinforces the perception that certain materials hold strategic value beyond short-term pricing. Institutional investors monitoring these shifts often reassess the role of real assets within their own portfolios. As capital begins to migrate, the distinction between financial valuation and strategic possession becomes more important. In purely financial markets, assets are priced based on discounted future cash flows. In environments where supply chains and resource security gain prominence, ownership itself becomes a form of optionality. Companies that control proven reserves are no longer evaluated solely on current earnings. They are assessed on their ability to provide future access to scarce inputs. The suspense in this final stage lies in timing and scale. Institutional capital does not move all at once. It flows in stages: initial exploration, small pilot allocations, performance validation, and then broader adoption. Each stage increases demand incrementally, yet the cumulative effect can be substantial. Because the sector's capacity to absorb large inflows is limited, even gradual reallocation can produce sharp valuation shifts. For entrepreneurs and business leaders observing these dynamics, the broader insight is about asymmetry between capital size and market depth. Opportunities often arise where large capital pools cannot enter quickly without affecting price. Identifying such mismatches requires looking beyond headline market capitalization and examining actual trading liquidity and ownership concentration. At the conclusion of this analysis, the narrative does not depend on dramatic forecasts. It rests on structural relationships. A weakening traditional hedge, expanding margins within a small sector, constrained physical supply, and underallocation by large institutions create conditions where capital rotation becomes increasingly probable. When that rotation gains momentum, the repricing may appear sudden, even though the underlying forces have been building quietly. The final strategic observation is therefore measured rather than sensational. Markets adjust when incentives change. If major asset managers conclude that preserving purchasing power requires greater exposure to tangible resources, their allocations will follow that logic. Given the limited size of the precious metals and mining space, such adjustments cannot occur without affecting valuation. The outcome is not predetermined in timing, but the pathway is clear. When large capital seeks scarce assets, price becomes the mechanism that balances access. In this environment, disciplined observers focus less on daily volatility and more on structural flow. They recognize that liquidity, not headlines, often determines the speed of market moves. And they understand that once institutional consensus begins to shift, the window to act before full repricing narrows, quietly at first, and then all at once.